Happy Monday, Jennifer Landry with the Landry team at Homespire Mortgage, bringing back another Mortgage Market Monday, a week in review. Last week we received good news data-wise as far as inflation and the rate at which it's growing. But by the week's end, the Fed's Q&A with Congress really left us hanging regarding future rate hikes and whether or not we're on a pause or just skipped one. Well, hang in there because the data that did come out likely means more to the housing market than trying to gauge where rates are going. I'm going to pass it to Kurt to discuss housing starts, which is a good indicator of where the housing market is going.
Good morning. The housing starts report for May came out June 20th, and starts rose 22% from April, bringing us to an annual rate of 1.631 million units. That's a 13-month high and well above expectations of 1.4 million. Housing starts were up 5.7% year over year from May 2022. Building permits, which is also a good sign of future construction, actually rose 5.2% to an annual rate of 1.491 million, which also exceeded the 1.425 million that was expected. What's all that mean? In a nutshell, it shows optimism amongst builders about housing going forward. It shows that the builders feel that the housing supply is really short, the labor market is really tight, and they're optimistic that the rate hiking cycle is drawing to a close.
This is great news. Builders don't start new construction if they feel that they may have to sit on that inventory for a long amount of time. When they feel pessimistic about the future, they tend to switch their focus on selling, getting rid of that inventory, whether that means reduction to the price or offering higher incentive. Even better, we also learned that existing home sales and inventory played into that great news from last week. And Kurt can't wait to summarize those numbers with you.
With all this good news as far as the data is concerned, why didn't it translate over to mortgage rates? Well, let's take a closer look at the data for a minute. Housing starts and building permits are up. That's a good thing. While increasing supply to the market seemingly does help force prices down, there's no way to really know for sure how quickly these homes are going to hit the market. That's what the Fed is trying to balance as it pertains to rate hikes, which is why in the Q&A, the Fed chair kind of played it close to the vest as far as what his intentions were. If they continue to raise rates at this meteoric rate, they can do some heavy damage to the overall economy. But on the flip side of that, if they put the brakes on a little too early, inflation may see an uptick, and then all of the past year's work to rein in that inflation may kind of be in vain. It's really a balancing act for the Fed. On top of that, producer price index was seemingly ignored completely by the Feds. Just to give you an idea, the producer prices for goods fell 2.4% for the 12 months ending May 2023. That may not sound like much unless you look at the previous year over year from May 2021 to May 2022, where the producer price index rose 16.7%. What was definitely not ignored by the Fed was the global composite report and those indicators. Globally, there are certain regions that are heating up inflation-wise. The UK, for example, is contemplating their central bank's rates higher due to greater than expected inflation numbers. Bear in mind that the UK has raised rates at a much slower rate than the US. They have lost some favorable trade agreements when they chose to exit the EU. And they're heavily dependent on natural gas, which has been pretty hampered by the war in Ukraine. While the Fed must keep an eye on the global sectors as it is intertwined with our domestic economy, knee-jerk attention without regard to the why behind the what is not what is proper for the long-term strategy of the U.S. economy. I think the Fed just kind of needs some time to absorb the data and strategize how rigorously they pursue future rate hikes.
Okay, in summary, supply is getting better, which should help with price. Inputs for new construction and material costs are coming down, which should also help with pricing and affordability in conjunction with supply increase. Rates seem to have leveled off. from increases, which should help with sticker shock effects to consumers. And we've also come up with some strategies to help consumers adjust to current rates and seize the opportunity that are in the current market pertaining to price and willingness to pay concessions. I hope everyone has a wonderful week. Please call us if you need anything. We're here 24/7, and subscribe if you like this content. If you want notifications for our Monday updates, hit the notification bell, and we'll see you next Monday.